Welcome back to, what is this called? The Unemployment Insurance Study Committee. Today is still October 19th, and we are coming back from a break. We are talking about benefit provision. We are trying to divide the conversation into things that are possible to change now. And then later on, we'll be talking about benefit provision that we could change in the future when the computers are also operating in the future. But before that, was hoping to hear from Cameron Wood from the Department of Labor about our conversation this morning and specifically what you see as the feasibility of raising the minimum, raising the maximum. In previous conversations, it seemed like those were the two policy levers available to us. So would like to hear your thoughts on that.
Absolutely. Good morning. For the record, Cameron Wood, Unemployment Insurance Director for the Department of Labor. Happy to try and answer any questions that the members may have as it relates to the minimum and maximum. What we've testified to in the past is that, you know, the maximum benefit amount is adjusted annually every year. And, you know, that's something that the system is designed to do. And so theoretically, if we were changing a maximum benefit amount to just reflect a different number, that is something that could be done. In addition, in having conversations with our ADS partners, it is more feasible. I'm trying to think how I would phrase that. To establish a minimum, or actually there's you know, less of a risk to establishing what could be an actual, you know, statutorily minimum than going in and changing the calculation or the divisor. And I want to take the opportunity when I get a second to maybe clarify a few things from this morning, but I'll pause right there and just, you know, kind of leave my comment and invite questions.
I guess to put a finer point on my question, we're curious about the department's proposal for how to get this additional money to Vermonters who the legislature has decided are deserving of these additional benefits. And so the two levers that seemed available to us are the minimum and the maximum. And we're curious if you have other ideas or if that's your idea for doing it too.
So I can't this morning speak for the commissioner or speak for the administration on potential different proposals of how to get money, you know, in the hands of claimants. You know, what I can speak to is, you know, my, you know, concerns about, you know, potential adjustments to the mainframe and the consequences that those can have on our department. You know, we've testified, you know, multiple times, and it was one of the things I wanted to clarify this morning. I don't know that we've ever said it's impossible to go into the mainframe and change the calculation. What we've said is we strongly oppose doing so because of the significant risks that it runs to the system as a whole. And if we're not going to address or adjust the calculation of establishing the weekly benefit amount due to those risks and concerns, I think from a systems perspective, if we can't do it the way we had intended last legislative session, and if we're not going to adjust the way that the calculation is established now, I think the next best thing, or the potential easiest thing, would be to adjust the maximum or try to adjust a minimum. And I'm saying neither of those I think are easy to do. It's just the things that we've identified as less risky than changing the weekly benefit amount calculation. So I am not, you know, sitting here this morning listening to the testimony and kind of, you know, just before you asked me to jump on, racking my brain, I'm not aware of any other way off the top of my head to try to provide additional benefits to claimants. Now I'm, given more thought, I could potentially, try to come up with something, but just on the fly this morning, I think your options are adjusting the weekly benefit amount calculation or adjusting the minimum or maximum outside of what we had tried to do last legislative session and some of the other conversations that occurred last year.
With all due respect, I can't imagine this is off the top of your head, given that we've been talking about getting more money to claimants for quite a while now. I'm not going to try to put a month on it.
Sure. Off the
Other
top of my
questions?
head, since that you've asked me to testify within a 10-minute window, and I can't speak for the commissioner or the administration about what would be feasible.
Senator Strachan?
Thank you, Cameron. So just to be clear, you're saying that doing the maximum would be the most feasible of the choices, but that you could also do a minimum, raising the minimum without in extra benefits for people and not disqualifying people who don't have the traditional earnings up to the new minimum.
So I'll take the quick opportunity to potentially clarify something. I'm not in, without having the data right in front of me, assuming if I know where the data came from, I want to clarify one of the points that was made just a minute ago or earlier in your session about the distribution of benefits in that graph. Penalty weeks and offsetting remuneration, et cetera, don't have anything to do with the establishment of somebody's weekly benefit amount. So if an individual is established at 0, that means that they're monetarily ineligible. And so I just wanted to clarify that if there are people at the lower end of that graph who have lower weekly benefit amounts, that if the data is showing their weekly benefit amount calculation, that would have nothing to do with penalty weeks or offsetting earnings, et cetera. Those would be based on the earnings that are in our system to establish that weekly benefit amount. So I wanted to clarify that at least, or, given the opportunity. To your question, Senator, from my standpoint, anything we do comes with risk, and I'll explain my concerns here. We adjust the maximum weekly benefit amount every year, and I can tell you that even doing that within the past few years has created issues in the mainframe system, which has resulted in potential overpayments being established and potential incorrect amounts being issued out to individuals. We're not underpaying anyone, to be clear, but even doing this routine annual redetermination over the past few years has created issues with the system, which has resulted in incorrect payments being issued to individuals. So from my perspective as the UI director, when it's my job to ensure that we are stewards of the trust fund and ensuring that the program is being run in a manner that is consistent with the law, even adjusting the maximum benefit amount right now is risky from my perspective, because I'm seeing the actual problems that are occurring when we do that. However, we're not in a position, and the department's not here telling you, let's not continue to do that. That's not our position. So you could adjust the maximum because we're going to have to do it every year anyway. It still comes with risk doing so, as I've just talked about. What we've done in having internal conversations with our team and with our ADS partners is we've identified that changing the weekly benefit amount calculation comes with significant risk because it hasn't been done, as Damian testified this morning, since the 80s. And it's not something that we are supportive of doing because of the potential consequences that could occur if something happens with the mainframe. Alternately, there has been discussion about setting a potential minimum. And in our discussions, we've said that that comes with significant risk as well. However, less risk than potentially adjusting the formula to calculate someone's weekly benefit amount. So I'm not here to say that absolutely we're supportive of that and we know that we can do it successfully. I'm just saying that it comes with less risk than adjusting the weekly benefit amount calculation. Whether the administration and the commissioner would be supportive of that, I can't speak to. I can just say that it is something theoretically you can do. And in our conversations, it's something that has been identified as less risky than adjusting the weekly benefit amount calculation.
Senator Pearson?
Thank you. Good morning, Cameron. So I'm hearing you say that, absent this discussion, absent the recent change in Act 51 that we passed and the governor signed, there's a risk to the system every year, just from the standard, basically updating of the annual calculation, right? And
Yes, sir.
that is new in the sense of it's in the last few years that risk has increased, and I gather that's based on the lack of state employees in your department that are fluent in this mainframe programming, right?
I
Do
think
have
that
right?
I think that contributes to it. Yes, sir. I think it's also just the nature of our mainframe becomes more and more, I should say, less and less stable as we continue to make adjustments to it. But yes, sir, I think that is a factor.
So I'm curious, given that even outside of our sort of current conversation, you're facing these issues, have we not been able to find a computer consultant that you can work with around making these changes, and or do you have somebody that helps you with those, again, just in the standard run of the department?
I would defer to ADS on being able to answer that question specifically. I will say that there are external partners that we are working with, not only to provide individual resources to help get work done, but also to help and I think as you all are aware, we did migrate the mainframe from, the Department of Labor's location to a third-party entity, and, they have been assisting with that. Anything, any diving into specifics there, I'd probably have to defer to ADS, but I do know there are external partners that we are working with to try to get resources and to try to help, alleviate the risks that we have.
ADS is here this afternoon.
Yep, thank you.
Senator Stockton?
So Cameron, I get the gist of that you're saying there are risks in it, whatever we do, and the administration is not, at least today, in a position to support a plan to get $100 million restored to claimants that they're not getting now. If we came up with a plan before our next meeting, would you be able to put your stamp of approval on that? And or are we going to have a legislative battle over restoration of these benefits?
I don't know, Senator, that I'm the person who is best to answer that question. I would probably defer that question to Commissioner Harrington. I don't want to say that we're opposed to anything without seeing it. So I wouldn't be comfortable telling you that we would not review any plan that is discussed. I think with any solution, we're happy to take a look at it and provide our advice or recommendation back. But I would defer that to the commissioner or the administration.
One other narrower question is there computer complications, or is there something we can do outside the computer to restore the benefits to those people who are not getting the $25? Or if we decided to raise the maximum, can we go back to the date of October 6th?
Yeah, I'll take those in reverse order. I would want to talk with our internal people and with ADS about a retroactive application. In my head, I'm thinking about the concerns that I have, because those are some of the issues that we've run into even over the past few years with adjusting the maximum, is applying retroactively and issuing incorrect payments. So I would have some concerns there, but I don't want to sit here and tell you it's entirely a non-starter. To your first point, we have issued payments outside of the mainframe. Yes, sir. So the LWA payments, for example, and the VSTS, the $100 weekly payments that we made during the month of October last year, we issued all of those payments outside of the mainframe. And, so that is doable. Again, my concerns with administering that would be running into issues like we did with the 1099s earlier this year. Anytime we're maintaining information outside of, an IT system, it becomes Excel spreadsheets and it's ripe for human error. And I would just be seriously concerned about that. But, it is something that we did for those two programs. So issuing them outside of the mainframe it's feasible, but as the person administering it, I would strongly advise against it, just because of the application of that in practice, I know is ripe for error.
Would we also have a conformance problem if we issued up to the bump in the maximum from the trust fund dollars?
If we increase the maximum with trust fund dollars, if it was retroactive, is that what you're asking, Senator? I don't think so, but I will caution and highlight very strongly, based on, the issue with the $25, I would like to run that by USDOL and make sure that is something that is in conformance. I was one that thought we could do the $25 weekly payment and turned out to be incorrect. So I think so, but I think at this point we would be looking for sign off on any major changes from USDOL moving forward, so we don't run into that issue again.
Thank you.
Cameron, do you have a mechanism for getting feedback from USDOL beyond sort of the slower path that we seem to be in right now?
Unfortunately, no. It is extremely challenging, as I'm sure you guys are facing. You're trying to make policy decisions. We have to work with USDOL on a weekly basis when it comes to implementation of programs, etc. It is extremely difficult to get responses in a timely manner. Unfortunately, any significant question around policy or conformance has to go all the way up to the national office. So, we reach out to our regional counterparts, and then they, tend to, have to forward that on to the national office for a response. Hopefully with, CARES Act related programs ending, the burden on them is less when it comes to questions, about those programs, and hopefully that provides more bandwidth to answer, typical, program related issues. But unfortunately, I mean, we have contacts in the national office that, we could reach out directly to. But, and we can include, hey, we need this information as soon as possible, et cetera. But, I don't know of any separate avenue to try to get information from them that would be something we could hold them to account for.
Thanks. Senator Pierce.
Cameron, I heard you clearly say that you didn't favor or that there were risks with trying to Senator Sorokin's question, trying to deal with the retroactive nature sort of outside of the mainframe. But just so we understand the options in front of us, if we were to come up with a solution that was outside of the mainframe system, so had to be, in addition to what people were getting in their weekly checks, is it doable then? Is it possible legal for you to bill back the trust fund, even if it is sent out in some sort of ancillary process?
Right. I will, two thoughts immediately come to mind. One is, and why I would want to make sure we get sign off from USDOL. I think in general, there could be a conformance issue. I think USDOL expects, I can't point to anything in federal statute off the top of my head, which is again why I'd want to reach out to them. But, we're not supposed to issue, UI payments in multiple issuances, if that makes sense. I mean, if you issue a weekly benefit, it's supposed to be issued once a week. It's not supposed to be issued twice a week. You can issue it bi-weekly, but for example, on the federal programs, FPUC, for example, the guidance and the requirements were that you issue it at the time that you issue the UI weekly benefit amount because of their requirements that they be issued at the same time. So with that said, I mean, we issue adjustment payments on a daily basis. If we, make a determination that somebody's owed X because of their earnings, but then later on we find out there were missing earnings, and then that report is submitted and adjusted, we issue an adjustment payment that goes out and pays them, retroactively for the weeks that they should be made whole. So it's not to say that never happens. But if we're saying, in statute, we want to retroactively increase the maximum to X, and therefore we need to reissue payment to all of these people, I would want full sign off from USDOL that that's not a conformance problem. And the other instance, or the other issue there potentially is issuing it from or via a separate source. In theory, if you are adjusting the maximum weekly benefit amount, you can use UI trust fund dollars for that purpose. But as we're adding layers there of it's retroactive, plus we're going to issue it using a separate system, USDOL may have concerns there. So again, I would just want to make sure we have sign off on any of those details before we put something into legislation and move it through. Separate from that, my administrator, role and brain is kicking in here. And again, I would have serious concerns about trying to administer something outside of the mainframe. And I want to belabor this point a little bit because I want you guys to know that I'm not saying this to just stonewall you. From my perspective, where my brain goes is, if we adjust the maximum weekly benefit amount, but we're issuing the payment from a separate system and it's not reflecting in the mainframe, now I have a mainframe system that potentially shows X, but I have separate payments going out the door. So now it really is Y. And when an auditor comes in, we get audited every year, and they want us to validate the controls that we have in place to ensure that people are getting the correct amount. And we're saying, well, we have a system that shows this, but then you have to remember there's this other thing over here that we pay people. And then when you're talking about collecting overpayments and you have a system that shows X, but now we have to remember Y, and it becomes an administrative nightmare to ensure that we're, able to do that correctly, and being able to demonstrate that to an auditor becomes extremely challenging. So I'm not saying that's where you were at, Senator. Again, in theory, if we are able to adjust the maximum benefit amount in the system, you hope that it's all self-contained within the system. But I just wanted to take the opportunity so you guys know from my perspective and the conversations I have with my commissioner, et cetera, when we're talking about administering a program in multiple systems, there are all of those controls that we don't have in place, and an auditor is going to quickly come in and say, what are you doing to manage this? And it is extremely challenging to actually do it in practice. So I just wanted to take the opportunity to raise those concerns as well.
Sure, I understand that. I will always take bureaucratic headaches over shorting, our workers, which is where we are today. I guess I was curious if we were, as a possible solution, just let's say to make up the 4 or 5 months, if it was potentially, if there was a potential to bill back, and then we made it part of your system. So I appreciate the answer. Thank you.
And again, Senator, I think, again, I'd one sign off from USDOL, but I think in theory, I don't, if they signed off on it, I think we would be able to use trust fund dollars.
Thank you, Cameron. I think with that, I would like at least to switch gears to a slightly more cheerful topic, a hypothetical future where you have a computer system that works. And in that hypothetical future, which I think we're all imagining is about 5 years out, safely, though Senator Pearson is on JI Talk, so maybe he could speed that up for us.
Yeah.
We want to talk about what benefit provision would look like there and what trust fund sufficiency would look like there, so that when you all are designing that computer system, we make sure that it's robust enough to handle at least our current statutory imagination, if not a future legislature's statutory imagination. So thank you. Do you have anything else you'd like to add before we switch gears?
At this point on the first topic, I think I'm good. Thank you.
Okay. Thank you very much for your time and for hanging out with us through this. So I think we're gonna hear from Damien right now. And folks, again, the idea is that we want to make sure that we're taking the time to actually imagine this future so that when the IT system is built, it can do the things we want it to do. And so one piece of that is what adequate benefits would look like. And then the other side is how we keep what trust fund sufficiency would look like. And so Damien is going to take us through a hypothetical proposal for benefits provision. It is, of course, not Damien's proposal. It is sort of my proposal, sort of Representative Marcotte's proposal. It's really just something to get us started in having a conversation about what we might want to do.
Okay.
Okay.
Good morning, everyone. So I'm gonna share. In just a moment, I will share my screen and I'll walk you through what I'm referring to as a progressive unemployment benefit structure, and I'm calling it progressive in the same manner that you would call tax schedule that taxes higher earners at a higher rate versus lower earners at a lower rate progressive, meaning the rates change progressively. So this is not progressive with the large P political party progressive.
Thanks for specifying.
Want to be clear with that. It is amazing when you search progressive unemployment benefits, how many of the things that turn up on the internet just relate to politics rather than to the actual structure. So that's why I'm clarifying. So I can now share my screen. Let's see, there we go. So this should be coming up for everybody. So what we're looking at here under our current formula, it's a flat rate. So as we discussed earlier this morning, you take your two highest quarters in your base period, you divide the total wages in those 2 quarters by 45, and you get roughly 57.7% of your average weekly wage up to the maximum, which is currently $583, which is 57% of the state average weekly wage for the previous year ending on May 31st. So the wage replacement is flat up until you hit that maximum weekly benefit. After that, you see a decrease. As we discussed this morning, one of our options is adding a minimum benefit, which does create a sort of progressive structure because you're paying at greater than 100% for the lowest wage claimants. Then you're paying at the 57.7% for everyone in the middle. And then you pay at a diminishing rate for folks who are over the maximum. A true progressive system, though, would vary the wage replacement rate based on the claimant's income. And so a basic example of this would be base period wages up to X amount are replaced at 65%, and wages above X are replaced at 55%. So what you do here is you avoid sort of the cliff effect, where you would say individuals who earned up to X get 65%, individuals who earned between X and Y get 55%, by basically saying as we get to those higher levels, we're just diminishing the wage replacement as we go on. And then you could also include maximum and minimum benefits to go with that. For reference, there were some questions about states that have set a minimum benefit. We're going to be looking at a couple of proposals here that have proposed a minimum benefit as a certain percentage of the state or national average weekly wage. There are 4 states that currently do that. Washington State is one of them. Theirs is set at, I believe, 15%. Kansas, and my information is from 2019, so these things could have changed in the pandemic. Kansas was the high at 25%, and I believe one state was as low as 10%. So, and that's just states that have set it as a percentage of the average weekly wage. Other states may have set a fixed dollar amount that they may or may not have an inflator. So the first proposal here is from the Economic Policy Institute. The first thing to note is that this is part of a much broader proposal from that organization to overhaul the unemployment insurance system. So this is just one piece of that proposal, but it addressed this issue of what's the adequate amount of benefits. And they've settled on a fairly high wage replacement rate, at least relative to the other proposal we see here and what's currently in our statutes. So for them, for individuals up to 50% of the state average weekly wage, they're suggesting a wage replacement rate of 85%. And so our state average weekly wage for 2021 is roughly $1,022. So half of that is $511, which means that you get to a minimum benefit of I should note with their proposal here, they also had, and Joyce highlighted this in her testimony, they had a proposed minimum benefit. And she highlighted the range in $20. Doing the math here, their minimum would be about 307, which is fairly close to some of the numbers Joyce was discussing this morning. So that gives you an idea of where how that would affect claimants. But then this would replace, be 85% wage replacement up to $434 in benefits. The next group or the next block on wage replacement is the 51 to 100%. They would suggest reducing the rate to 70% there, which is still significantly higher than our state's wage replacement rate now, which would get you up to $793 in benefits, which again is significantly higher, more than $200 higher than our current maximum weekly benefit. And then over 100% of state average weekly wage, they would do a replacement rate up to 50%, all the way up to 150% of the state average weekly wage. So they're talking about setting the max at almost 3 times what it is currently in our state. So obviously this is, a proposal that has significant benefit increases tied into it, but at the core of it is sort of this wage replacement rate, and you could adjust those numbers in here so it could be up to 30%, 60%, and 100% of state average weekly wage or something like that. Or you could even say we want our maximum to be 80% of state average weekly wage, which is what the second proposal does here with the US average weekly wage. So I've labeled this as coming from Arindrajit Dubey, and it's the same Hamilton Project proposal that Joyce mentioned. The reason I attributed it to its author is because the Hamilton Project is a public policy forum, so they don't necessarily endorse the proposals that are put forward in the forum, but that it's intended to give thinkers on public policy issues a place to put these proposals forward and then generate discussion around them. So this proposal here, again, would set numbers here at fixed dollar amounts up to 400, 400, 700, and over 700. Again, you could work with that, but the replacement rates are similarly high for low-income earners. We're looking at 80%, then 65% in the middle, and then 50% for the top earners, up to 80% of the US average weekly wage. Of course, for our purposes, that could be changed to the state average weekly wage. But what you see again is much higher wage replacement at the bottom end. And then again, this proposal would have you setting the max higher. So you don't have quite as many people hitting that maximum benefit. And instead you have wage replacement going up. So in this case, this is close to 90% of our state average weekly wage. So that's the two proposals here. There's a great deal more discussion about them at the links I've provided in here. And so if this is something that interests a member of the committee, you can go there for more information. Again, the issue of where you set these numbers and what the replacement rate is really a policy question. That's up to all of you. But this is a potential formula. And it seems, at least at this point, from what I know, that this is not something that the federal law would prohibit. So the federal law and USDOL has stated this in several of their publications, does not set standards for the amount of benefits, but it does set standards for how they're paid and how they're administered. So that's why we have such variation across states, why some states have minimums and others don't, why some states have maximums that are almost $1,000 a week and others have them under $300 a week. So that this kind of gives you an idea of what you could do. Obviously, this is far more complicated than our current flat rate formula. Are there questions on this?
There's Rucker.
So is this instituted in any state that you know of right now?
No states have progressive benefits formula like this. The closest that any state comes that I'm aware of is Iowa's dependent benefits formula, where you get a higher wage replacement, a higher flat wage replacement rate, depending on the number of dependents you have. So individuals with no dependents receive the lowest rate, and individuals with, I think, 4 or more dependents receive the highest flat rate. But it's not tied to income at all. It's tied to the number of dependents.
So obviously this question is going to come out at some point, but I wonder if, and I look generally at the stuff you sent out from EPI and stuff. Do you know the arguments pro and con? I know the arguments pro and I probably support those, but it seems like we have systems like workers' comp, social security, disability payments where income is not relevant to the, and so is this turning UI into an element of needs-based? Is read, what, are there pieces against doing that? What do they say?
I haven't done a lot of extensive reading on this. I think, you know, to some extent, there's the policy question of, is UI intended to be a needs-based program, or is it intended to be short-term wage replacement, and then programs like temporary assistance to needy families or SNAP benefits are more focused on the needs-based assistance, or SSI. And so there is the question of whether this program, which was originally intended to provide wage replacement when you're out of a job, and traditionally had been around 50% of your wages, whether this is intended to be a needs-based program. Obviously, these two authors here are arguing that it should be needs-based, and that this is a change that should occur after roughly 80 or 90 years of, or 80 years of unemployment insurance at this point. One of the other potential arguments against something like this, particularly these two proposals, is just the additional stress on the trust fund, which you have to find a way to pay for it. So again, that becomes sort of a policy question of what's the appropriate amount to ask employers to pay to fund a benefit like this, and conversely, what's the appropriate sort of benefit amount that we want to pay for, and who should be receiving that benefit. So those are sort of the questions that come up. One of the other potential issues that we talked about this morning is the sort of the moral question that comes up, and Joyce, I think Joyce called it induced, sort of induced participation in the program, where individuals will say, wow, I could be unemployed and receive X number of dollars. And so then there's that question. Again, as Joyce mentioned, there's no real hard data that shows that we have at this point that shows whether that's an actual real issue or just a potential perceived issue. There are safeguards in the program, such as the job search requirements, the weekly filing, that don't make it just as easy as saying, I want to quit my job and take unemployment, because you actually have to be unemployed through no fault of your own, and then searching for work and so forth. So there are a lot of safeguards already built into the program, but there is this sort of question of, if we set the benefits too high, are individuals going to stay on unemployment longer, or find ways to get on unemployment and try to defraud the system or something like that? Again, I haven't done a lot of reading on these, and I don't have an opinion, but those are some of the arguments that are circulated around the issue of raising benefits or doing something like this.
And I'm trying to get someone from the Economic Policy Institute who worked on this paper to come in and talk to us.
Yeah, I would like to say that Social Security very much, it does have a progressive structure. If you think about the way that the benefit is calculated, you start with your high 35 years of earnings, and then they determine the average index monthly amount, which is basically raising your faraway earnings up to current dollars, right? So that you have a level earnings amount across the years. And then if your average index monthly earnings are low enough, you get a 90% replacement rate. Now that's really low earnings. But then once you move above that, the next level, I think, is 30%. I'm trying to find it right now and I haven't found it yet. I think it's 30%. But I'm quite sure that the top rate, if your monthly earnings are high enough, the replacement rate is 15%. So it's very progressive from the very lowest end to the higher earnings levels. So that's an example of a progressive benefit structure.
Thank you.
A couple questions. Can you just, I know 45 is in our statute. What is it? Is it just the legislative process pushed it through some formula for the poor JFO person at the time and it was roughly right and they put it in law? Or is there a reason we have 45?
So I am not sure why we ended up at the 45. I have not pulled the file from them, and just most of the sort of archived files from back then don't have the substantive discussions. They just have the drafts, and if you're lucky, some scribbled markup from when the committee was marking up with the legislative council staff person.
Okay.
And a lot of times you don't get the discussion between, the committee members saying, well, 50% where we were at before was too low. We'd like to go to 65. Let's settle on 57 or whatever happened then. So we could certainly look back at that, but I don't know why we ended up there. I will say that across states, the variation is, it's really all over the place. A lot of states cluster around 50%, which is sort of the traditional rate. But then you do get states that go as high as something like 65% on their wage replacement. And then those states also vary in terms of their maximum. So some of them go as high as 65%, but have a low maximum. And other states like Massachusetts don't have a very high wage replacement rate, but they have a high maximum. So there's broader range.
And this is a number we're not allowed, the mainframe will explode if we play with that number, right?
This is our future thinking.
No, I understand the exercise. I just want to,
Yeah.
I haven't been immersed in this.
No,
Unfortunately.
totally.
So in terms of looking forward, you presented a couple of options. I'm not sure how detailed you expect to get, Madam Chair. I mean, to me, I hope we won't spend too much time getting detailed because it's 5 years from now. This stuff is all so fluid in terms of the economy. But what I'm hearing is, we would want a system where you can change any variable that you want and not have to face this bureaucratic tension. But also, as Damien's, this helped me in the sense that we also don't want to be forced into one formula for the whole population, right? So, which doesn't seem like it would be that hard, but I could see us saying, yeah, we want a solution that lets us play with any variable, and then we come forward and say, actually, we want two formulas or a tier it, and the new text says, well, we can only handle one. So that seems to me, I'm trying to think of the more general principles that we're uncovering here rather than worrying about where we want to land.
It's worth noting too that in the proposal by Professor Dubé or Dubé, I'm not sure how the last name is pronounced, but in that proposal there was also the other piece of that was the idea that when you have high unemployment, benefits increase, and Joyce touched on this in her proposal. But you would see the minimum come up and you would see the wage replacement rate increase at each level. And the idea then being that if there are very few jobs available because unemployment is so high, then you have less worries about individuals who are being induced to stay on unemployment because they're receiving the wage replacement rate. And the flip side of it is you're pumping more money into the economy to hopefully get consumer spending. So that was, and I'm paraphrasing the professor's argument, but that's another piece of this that goes to your discussion about being able to play with the variables. So it may be that you settle on a flat wage replacement rate is the easiest to settle on. But we say when, say when extended benefits trigger on or something like that, which only happens when unemployment is elevated, then we would also trigger on an increased benefit amount. So that's another piece that the committee could consider as a potential option going forward in the future for right sizing the benefits.
Thank you.
Big picture, I think there might be some use in moving this conversation forward by saying, this is what we would like the benefit structure to look like, and we set a date certain that's 5 years from now as a way of maintaining momentum around actually fixing the IT system and keeping everyone on the same page with fixing the IT system. But I hear what you're saying about just specifying principles of a high functioning system. And maybe that's where we get to. One sort of principle of that I'm curious about is if we are shifting, I'm trying to get my head around what it looks like if we think about this in the context of hourly rather than weekly replacement. And if that's something that if we think about what Washington, is it Washington that does? All that.
Yeah. So Washington, they look at hours for your qualification, but then the wage replacement is still based off of your total wages earned in, I believe they're a high quarter state, but I'd have to just double check. So with Washington, the qualification, they're looking for that sort of time that you've spent in the workforce to say, this is a connection to the workforce that we think is appropriate for you to qualify for benefits. But then the actual wage replacement rate, they base it on your 2 highest quarters. And then they take your weekly benefit amount as 3.85% of your 2 high. With the minimum set at, I believe it's 15% of the state average weekly wage. And then the maximum is a different percentage of the state average weekly wage.
So they're still replacing on sort of the sum rather than on an hourly basis.
That's right.
Okay.
And I think it's an interesting idea to think about replacing.
I'm just telling the group that.
Representative Marcotte, can you hear me?
Yes.
Technical issue.
We've had a technical issue in the room here, so we're going to take the lunch break early while we correct the technical issue. So for folks who are on the stream, Madam Chair, what time will we be coming back? We will be coming back at 10 to 1 after we've taken a lunch break and corrected the